Turnaround Tuesday, everybody. How's everyone doing today? Nareej, we'll get Steve to talk about Nifty 50 for you. So I just want to talk about a couple of potential scalps. I really don't like to have a time frame for when I have to be out of a trade, and I'm not a big believer in trading and holding positions into a Fed decision or the NFP on Friday. So anything I talk about now would be a scalp, and I'd be out before the Fed decision tomorrow. So in the end, we're starting to get some glaring 4-hour divergence. Didn't quite get to the weekly line up here, whereas the dollar penetrated it, but we're right there in the end. Pretty close to this on the end. The 1 hour is not so great. It's above 80, but it has a weaker RSI structure than something like the Dixie. As you can see, the Dixie has penetrated the same type of line up here, and really no divergence on the 1, and marginal divergence on the 4 hour. So the candidates that have the best RSI structures for a move today may be Aussie. As you can see, although Aussie just a shade under 30 on the 4 hour, holding it here on the 1. Also the Swiss diverging on the 1. Diverging on the 4, although not ideal, above 70. Everyone with me? Okay. So actually, Aussie looks like a decent shot. Wait for a reversal candle. Maybe we could get a rally back to 76 or so. And US dollar yen, especially if the S&Ps fail and there's some nervousness. We had a pretty negative day yesterday. So if the S&Ps can't get back through 60 and start to challenge last week's lows, perhaps we get this risk-off move in yen. Pound under a lot of pressure. Don't forget last week, talked about Euro Pound. There was a nice little break to buy. I still think when I look at Euro Pound right here, yesterday was a nice break to buy at 760. Maybe there's another pullback, but I look at this and all the bears are saying, well, you know what? This was just a, little short squeeze. The trend's still down. All the people down here, I think they want stops up here and here. So I still think the squeeze is on in Euro Pound, and it may be more about the pound being weaker than the euro on down days. We'll see. But even the pound has a third drive down here. It's hanging on by a thread, but liking Euro Pound, it's hard for me to want to buy the pound because that's the preferred short. But as you can see, we have a 1, 2, 3 here, trying to hold some divergence here. So basically the theme is short the weakest, buy the strongest, and right now to me it looks like Canada's the weakest, okay, because it's not making new highs with the dollar. It's not making new highs like the yen. So of the dollar pair so far, Canada's the weakest. And I think the yen has a chance to pull back should we get follow through to the downside. And S&Ps, it was pretty ugly close yesterday. The line did not quite manifest here. It looks like it comes in around 108, 109.80. So those are my views, and with the dollar strength, the pressure continues in the precious metals. We're only about $7 away from a stop hunt in gold, something that I've been talking about for about $20 or so. I think we're headed at least down to here, 1286 or so, and still believe silver has a flush to challenge and take out this low. So those are my calls. The next one's yours. Just kidding. Okay. Hello? Okay. Yeah. Okay, Mike, with you? So give me a Y if you're with me. Also, the team has some Euro Yen shorts that are working. This may have been the failure, kind of a rising wedge that Steve showed and Blake showed, still under pressure. Decent trade if they could get the yen working to the downside, it could accelerate. Have a very good guest today, John Chevreau. Jonathan has over, I don't know, about 75, 80,000 followers, was known for his macro views, but he also has a new mission, something that I thought I was too smart to even plan to do, and that's your retirement. You know, what we do here in FX should be about 10%, our speculative end of the portfolio, but you still need planning so you have money left and you could retire comfortably. So he's got a new website dedicated to that. And I'll be talking to Jonathan about that. So it's one thing to make it, it's another thing to keep it. And Jonathan Chevreau will be speaking to us about that at the top of the hour. Also this week, you probably got notifications, Mark Yusko is going to be with us tomorrow. Mark is very well known. He's on CNBC all the time. And I did get confirmation for Jim Rickards to be with us Thursday, the author of Currency Wars. I'm going to ask him who's winning this war. So at this time, I'm going to call in my good friend and teammate, Blake Morrow, to give you his views on King Dollar, King Dollar, King Dollar, the Kudlow dollar rally underway. Any respite that you see coming in here, Blake?
Hey, Dale. Good morning.
Hey, buddy.
And
good morning.
Hey, hey, just wanted to say your microphone sounds awesome, man.
Great. Yeah.
Sounds great.
Yeah. I've seen no messages, Dale. You're too low, and all of that. So thank you guys for the headset because I want people to hear me.
No, you sound great.
Thank
so
you.
you were asking about the dollar. You look at the euro dollar right now. We're at the 200-day moving average right at this moment in time.
Wow. So and it's also at that line. I had a line before you'd grab it. Let me just show everyone that it's actually through it. And I had this line drawn, Blake, for weeks and thought we could get here eventually. No reaction on it right here, but go ahead, take the screen.
Oh yeah, I was just gonna say we're right at the 200-day moving average. It should be here at 120.10 or so. Let me grab the screen really quick. But we're here, and the dollar is just exploding against everything. So I mean, here's the euro. We had this little consolidation, which I thought was actually going to last longer. I was hoping it would. I had orders to sell the euro dollar that aren't going to get hit, obviously now. Not at this point. I should probably just cancel them all. But we're at the 200-day moving average. We're very close to it. So this is and the daily just went oversold. RSI doesn't mean that it's going to stop by any stretch of the means, but it is we're at what could be support. But you got to look around. I mean, the pound is below the 130. Whoops. The pound is below 137, which is the big, trend line. We have a double top that is now triggered. Now, you got to see how today closes. But if we close below 137 today, I mean, that's a big, it's a big double top in the cable, right? The Aussie, I mean, just getting blasted. We just creamed through. We're creaming through support here. You can see the Aussie dollar is about ready to take out all the stops below these lows. Let's see, that low comes in at, let me make sure I know what it is, 75.02. We're at 75.02 right here. So we're about ready to just break through all those lows and probably trip some stops. And it's pretty, I mean, we're looking at, here's the Aussie, here's the Kiwi. Kiwi's at the 161% extension, basically at 70 cents. That's probably going to take out the stops below 70 cents. So you got the euro at 120, pound below 136. You know, the Aussie and the Kiwi both look gross. Now the dollar Canadian stuck. You'd mentioned the Canadian is not going the way of the dollar, and remember the Canadian I think is sidelined until after the NAFTA agreement gets done. So once
Okay.
I think that I'm leaving the Canadian alone. I told everybody, you know, that pretty much since the end of last week, I'm not touching the Canadian anymore. I made good money buying it a week and a half ago, and it was like this trade pretty much made my month actually. If I look back at April, this was it. This is the trade for me. But you know, what do you do with it now? I don't know, and I don't think there's much to do with NAFTA coming up. So just leaving that one alone. The dollar Swiss is at the 88% retracement, continues to blast higher. I mean, this thing, look at how overbought the daily RSI is on the Swissy. I mean, it is way overbought. But you know, if you look at yesterday or 2 days ago, you would have said it was overbought. It's just more overbought. So things can continue to be overbought or oversold. So you know, but we, you know, it's got to be noted. And peso's same thing as the Canadian. You just kind of got to leave that thing alone for right now. Aussie is taking out the stops below 75 cents, as you would expect. So the Aussie is breaking lower here. Just tripping the stops. You can see it stop run, right?
Yep.
That was a nice little stop run. It's going to happen probably across the board. I would think that the euro takes some stops below 120, pound below 136.50, Kiwi below 70 cents. You got to let all these stops get shaken out. Look at the U.S. dollar Swedish krona. Look at how strong that is. We were talking about V-shaped recovery. I mean, I had this thing pegged. I'll be the first one to admit I had it pegged, and I traded it like a goof. I mean, I really did. I really missed the majority of this move. I mean, when you see an explosive move like this, and we were overbought when it was breaking higher. Look at the RSI. I mean, we're reaching spike high levels that we saw way back here. Does it mean it's over? No, because if you look at what happened when we hit the spike high RSI back here, we did continue higher. We did pull back. So, the risks of a pullback are there, but it doesn't mean it's going to. It doesn't mean it's going to stop the move. This is a extremely strong, you could call it impulsive move. So any dip now, you got to be a buyer. So for me, I'm probably looking at any significant dip in the dollar Swiss as being a long. As long as we stay above 850, we see this thing over the course of the next couple of days, whether it's the jobs report or FOMC or which you aptly pointed out that we have FOMC tomorrow. There's some chances for the dollar to pull back, but any type of pullback is going to be looked at as a buying opportunity in my opinion, especially with the dollar Swiss. Dollar index, we are above the 200-day in the dollar index as well. So the dollar index is approaching the 618 retracement, which comes in at 92.48. We're almost there. But and then we have some horizontal resistance. You can see we're getting into the resistance zone, if you will. So this is going to be some pretty key resistance for the dollar index moving forward. But there's not much to say right now regarding the dollar other than it's bullish. What do you do? I mean, do you sit here and try to fade all these moves? I think you can, try to do that, but you might want to let some of the stops get taken out first before venturing into some sort of counter trend type of move. But I do think that with the FOMC tomorrow, you got to be very careful buying the dollar at this point. Because what you're doing is you're getting people squeezed out of it because they just don't want their positions ahead of the FOMC. But that's going to subside, I would assume. Dollar yen's at new trend highs here, but we're also at a 50% retracement. This is a 50% retracement of here. Let me get rid of this quick. Okay, we're at a 50% retracement of the entire move lower from the 114, almost 115 level down to lows at 104.50. So the dollar yen is basically right there at the 50% retracement. So, and I've read numerous accounts that there's a lot of exporter selling here at 109.70. So a lot of orders standing in the way, and you notice how the dollar yen's kind of not moving higher. Maybe a lot of that has to do with bonds. Now let's take a look at. I'm going to talk about bonds for a moment because I want to show you here. Let me grab this chart. Is this this it? That I don't know if that's it. Hold on. Maybe that isn't it. Oh no, that's not it. That's it. Okay. So this is was circulating around our office yesterday, and this is a picture of the 10-year positioning in the 10-year. Okay, so the market is extremely short bonds, historically short bonds, and so that obviously yields are at 3%. So you got the bond market, okay, that is extremely bearish, but the market is extremely short. Okay, so the risk here is, and if you're looking at the 10-year, the risk is if we break above this previous support, which comes in at 119 and 119 22 30 seconds. Okay, you break above that resistance, and then you're going to see a squeeze in the higher in the bonds. That means yields are coming down. If yields are coming down,
yeah,
because
maybe that could be the trigger for the yen coming off for a bit.
It could be, or that could be, the trigger for the dollar pulling back.
Right.
Whether you're talking about the dollar yen or the
right.
euro dollar bouncing or whatever, that could be what does it. So I think you got to watch the bond market, especially that yields have already hit 3%. We've already probed up there. So if bonds rally, yields come down, the dollar might come down as a result. And that could be, the dollar yen that starts the move, and then you might see the euro bounce, and you might see the pound bounce, and maybe even the Aussie or the Kiwi, because I look at these, like you take a look at the Aussie and the Kiwi. I mean, these things have gone. This is one of those moves. If you think about this, look at the Aussie, and this is the daily chart. And if you guys remember December, I mean, this is December. We went from 75 cents to 80, almost 80, well, 81 and change, and then we've given back everything. All right. And I remember this move because it was, it's obviously during the Christmas holiday period, and the markets were closed, no, markets were closed. Volatility was low, and it was during holiday, and for most people weren't even around, and the Aussie for no reason was just blasting higher, and we were like, what the hell is it? But we've given back all of those gains back to where we started in the beginning of December, and there's a risk that we're just we're range bound, or at least we get some sort of bounce here. We are approaching pretty oversold conditions. Intraday, we're very divergent. You talk about three drives all the time. Dale, when you're looking at the Aussie dollar, how do you see that as far as your 3-drive look? What? Because I don't know the rules.
Let me look at my charts. Yeah, so basically the labeling would be the low at say 75.50, where I have next low to the left. What there? One more to the right.
Okay, right here.
Yeah, 1, then a little bounce, and 2, and now this would be 3.
So this would be 3, and relative strength is divergence. So
right,
and
that's part of it.
So what triggers do you
a reversal candle?
Okay, so you look for a reversal candle. So yeah. Like if you're looking at this 4-hour, you'd basically look for a hammer. You know,
yeah.
we reverse
that we might be getting here, and then you go with the close of the candle and protect yourself under the low with a little tolerance.
Okay, well, in this case, since I'm looking at a 4-hour candle, it's over in about 40 minutes. So we could, I mean, it's 75.04 right now. We'd have to get up to 75, basically 75.15, which is not. Could do it. Yeah, I mean, you know, of course it could. I mean, it's only 10 pips away, you know, and so, and then you'd be long with a stop below the lows. Right. I'm not a big fan of fading these huge moves, but at the same time, I look at the overbought, oversold conditions that we're in, and think that it's you know, it is a risk now. I think it is a risk that that we start seeing the dollar pull back here soon. So and it's worth noting. I think it's you know, whether you're looking at the Aussie, the Kiwi is probably a very similar situation. And this thing is, we just hit 161% extension here. Very divergent relative strength. It doesn't mean you should be buying it necessarily, but man, I don't know if I'd want to be short here. So I think the point that I want to make with the dollar pairs at the moment is that the dollar is strong, but also very overbought, and we have the FOMC tomorrow. So I think it does warrant risk, you know, for the dollar pairs. Let's also, before Steve gets here, I want to take a real quick look at gold and silver. So here's,
does the market believe 100% they're going to tighten tomorrow?
No, actually, I believe the Fed is expected to keep rates unchanged.
Oh, okay.
Yeah, if I'm not mistaken,
the market's acting like, you know, tightening is a certainty almost, you know.
Yeah. I mean, you know, I think the market's expected to keep rates unchanged, if I'm not mistaken. So, but we are expecting more rate hikes throughout the course of the year. Tomorrow, we're just expected to. I think if I'm not mistaken, we are expected to keep rates unchanged. So, and we have next month, I guess in what it would be June. I think our June FOMC meeting, we might have the market might be looking at a hike then. So
yeah, I think that's what the market is pricing in June, Blake.
Yeah. So hey, good morning. So the question is that we'll be looking for tomorrow is, you know, how hawkish is you know, the Fed governor and the Fed chair, and does he you know, signal that it could be even a little bit more, you know, that we could even price in, you know, quite possibly the 4 for the year. But you know, and there's obviously risk associated with what's happening between, you know, with the FOMC statement. So I think people are going to be a little bit more careful about being too aggressive with the dollar today. So we're probably seeing some order flow right now, but again, and Steve's coming. Steve, we just heard his voice. I mean, you look at like silver. Silver's at pretty key support here. Gold is right in the support zone, big support zone for gold that we've really respected all of 2018. So, you know, if gold bounces here, or precious metals just in general, you know, precious metals bounce, dollar goes down. So again, I don't know if I would be too aggressive with the dollar at this point. Does it mean you should be selling dollars? Well, maybe. I mean, if you want to take some counter trend trades, you know, you could always do that. I just don't know if I would be, you know, super aggressive. Anything that you do counter trend, you want to if you're trading counter trend, you want to make sure you're doing it in a small capacity, not aggressive. Amen. Because yeah, that's when traders really get hurt, is you start to get you know, aggressive counter trend, and then the market just bulldozes you. And we are in a situation where, you know, we start taking out stops. I mean, the euro takes out stop. Like, let's say you bought the euro here at 120.25, and you're like, oh man, it's going to hold 120, and then you get aggressively long, and it blows through 120, and then next thing you know, we're trading at, the stops are so great, we trade down to 119.50, and then you're aggressive and you lose 75 pips really quick. I mean, it's going to hurt. So, you know, I think it's just, you have to be very careful with what you're doing around here, especially if you're considering trading counter trend, which I'm not opposed to trading counter trend. I do it all the time. I just, whenever I know I'm counter trend, I just trade exceptionally small and exceptionally careful. So so right now, coming up, and I'm going to pass it over to Steve, because we have Canadian GDP coming out. Again, I'm not a fan of trading the Canadian currency at the moment, but I'll tell you, if Canadian GDP comes in a little bit stronger than expected, I think the trade here is just short the dollar Canadian with a stop above 129. If you, one of the other things I want to point out is, whenever a NAFTA agreement gets done, you have to imagine that the Bank of Canada, it's going to be open season for them to start raising rates. So that's why if or when a NAFTA deal gets done, I think being bullish the Canadian currency specifically is probably the right play. You know, do you short the dollar Canadian? I don't know. Maybe you know, if the dollar is still strong, maybe you short the euro Canadian. You know, something like that. I think that'll be the better play. But anyway, I'm going to pass it over to my colleague Steve. Good morning, Steve. I hope you're hanging in there.
Good morning, Dale, and good morning, Blake.
Good morning, Steve.
Yeah, it's been quite a rough night, but you know, it's okay. My wife takes the brand of it.
You know, it's challenging being a new father, and even though it's all, you've gone a few years, it's still, you know, it's still no, it doesn't get easier. You gotta wait for a couple more years, Steve.
Yeah, unless by then there is a new one, in which case, you know, we have to postpone the waiting.
Right. All right. Well, good luck, and we all appreciate you being here. So.
Okay. By the way, Andre is going to be with us as well. So, you know, he can also give us his harmonics perspective.
Awesome.
Yeah. So I'm going to speak for 15 minutes, and then Andre is going to take over. Hey, Dale, what's up, mate?
I'm doing okay, Steve. You know, if the dollar comes off, I just want to clarify to people again, if you're scalping counter trend, you know,
by the way, sorry to interrupt you. I've opened the USD card because we have data coming out. So I'm going to interrupt you when the data, when we have data, and then we will start covering things. As you see, the USD card has spent, probably in expectation of the GDP as well, has spent a few days consolidating here. Usually consolidations get resolved in the direction of the previous move, in which case, technically speaking, you know, I would find it possible to see a break to the upside, and the move towards 130. But you know, this is event risk, you can't predict in advance. So let's see what the GDP is, and afterwards you can we can cover everything else. I think we're just a few seconds away, and there we go. Let's see.
Non-event so far.
Indeed. February GDP plus 0.4% versus 0.3% expected. So it's a little bit stronger. Yeah, and 3% year on year, estimated 2.8, previous 2.7. So it's a little bit stronger actually than expected. But as you see, the dollar is holding 4 now. Keep in mind, if you remember several days ago, I drew this. Wouldn't surprise me if we saw a dip a little bit lower and then a continuation to the upside towards 130. But as Blake said, and I agree 100%. USD CAD is one of the most choppy pairs during the past few days. And in essence, we're in the middle of an ascending channel, as you see here. So in my opinion, much better opportunities out there. As Blake said, I wouldn't be putting my money right here, right now on the USD CAD. Okay. Regardless, the Canadian data were a little bit stronger than expected. Let's have a look at the CAD yen as well. If you remember, we had a look at it yesterday as well. I was expecting that we might get a break outside of this triangle, another push to the upside. We might go to the 86 level, which is a 50% fib. We might even, potentially, we might even push a little bit higher from there towards the 200 DMA and the 61.8. But I do see this move as a corrective move to this impulsive move lower. So one way or another, I'm expecting this move to fail. From a technical perspective, I'm expecting this move to fail. Obviously, to get confirmation for that, we would need to see a break below this channel. We're not even close to that. But regardless, since we had Canadian data, I just wanted to have a look at that as well. Sorry for interrupting you before. Go ahead, Dale. What were you saying?
Oh, all I wanted to do was emphasize that if any of these counter trend trades, like in the US dollar yen or long Aussie, give you a payday, to be out before the Fed decision tomorrow. Okay, I don't like roulette. I'd rather book it, and you have 30 pips in your favor, take half and tighten up stops. That's all.
Listen, use the yen, for example, since you mentioned it, is currently testing the 50% fib from this high, right?
Yeah.
A little bit higher, we have the 200 DMA. A little bit higher than that, we have the 61.8. Bottom line, between here and roughly 100 pips higher, we have multiple levels of resistance. It wouldn't really surprise me if we see a continuation from this move, because if you see in the short term, let me erase this and go to a 4-hour chart. This looks to me like a triangle in the 4-hour chart, right? Or a bull flag. And it seems to be breaking to the upside, which makes sense. Now, I would more likely than not expect that after we see another push higher, I don't know if the Fed is going to be the catalyst for that, but we should at least see some pullback. If not, a reversal and a resumption to the downside. So, in all honesty, I think that,
Steve, just to interrupt you for a second, get nice 1-hour candles in Euro and Aussie. If they
we're going to have a look at it. We're going to have a look at it right now. So, what I wanted to say here is the following. If you remember, I was quite clear that when we were creating this triangle here, the chances for at least one more leg to the upside were very high. I stressed that multiple times. I said that I expect this to break to the upside. So the reward to risk ratio was very decent here, but I don't think it is anymore here, especially ahead of event risk, right? Because I think that there is a chance, as I said, for another push to the upside, but we might not have a lot more room left to the upside before we at least see a pullback to 108. Now, let's assume that we've already seen a move start to the downside today, tomorrow, the day after tomorrow, due to the Fed or whatever. For me, a very important factor to determine if this move higher was a corrective one or something else is what's going to happen, from the 108 level, or a little bit lower than that, actually, like 107.80, 108 level. If we see a move lower, be slow and grind towards that area and find support, then I'm going to be looking for more USD yen strength, in essence, for more yen weakness. So let me be clear. I'm not 100% sure we should be looking for a continuation to the downside yet, but I do see a high likelihood that within the week we're going to have a pullback for the USD yen. So bottom line, no risk reward to be buying right here, right now. Now, you mentioned the Euro USD. Let's have a look at it. And you also mentioned the Aussie, correct? Okay. Let me say here the following. The Euro USD almost tested today the 200 DMA. A daily close below 120, but especially for me, it's this confluence, this low here, and the 61.8 at 119.36 is going to mean trouble. Until then, I still see the likelihood that this move is corrective because, we can interpret this move lower in multiple ways. But definitely, if we close below this 61.8% fib, which is also this low here, that high there, it's going to start getting very worrying for the people that are long. Also, the RSI is currently testing the 30 area. We don't want to see that break to the downside if we want to maintain somewhat of a bullish bias. So bottom line, I think we're going to know very, very soon what's happening with the Euro USD. What we said several days ago, and I heard Blake say it again once again today, is after seeing such a move in the cable, I will 100% looking to sell any strength. So has a double top being triggered? Yes, but does Mrs. Market is Mrs. Market used to first taking people for a spin before doing its thing? Yes. So it wouldn't surprise me to see a reversal from this horizontal support area that I have. It's at 136.20. Then a move above this 137.50 area. People saying that perhaps this was a false break to the downside, and once people get trapped, resuming once again lower. So I view this move as impulsive. I'm going to be looking to sell 139 and 140. I showed the levels yesterday on the 4-hour chart as well. And I do believe that one way or another, sooner rather than later, we're going to get a bounce. Now, nobody can know how big of a bounce we might get. We might even stall at the 138 area, because if we move a little bit lower, 138 is going to be almost 200 pips higher, right? So I might even consider moving I have 2 orders to go short, half position at 139, half a position at 140. I might actually consider moving those to 138 and 139. So in essence, moving my 140 short to the 138 level, because I don't want to miss the next leg to the downside. Equivalently, people were lucky enough to get a second opportunity in the pound yen to short it today after it retested once again this little horizontal support resistance area. At 150.50, 150.70. 0.75 for the Aussie is the line in the sand. If we actually close on the daily and especially on a weekly basis below the 0.75 area, we're going a lot lower. So we're already seeing a reaction from this level. Of course, it's very early on the day, but I have to say that especially if whoever is bullish loses this battle with the 0.75 area, I think that things become very, very. It's a slippery slope below there. So people that want to be buying, they really don't want to see that level give way. Also, at the same time, and not coincidentally, we very often see correlated pairs test important supports and resistances at the same time. As you see, the Kiwi is currently testing more or less the confluence of the 61.8 of the last move higher and the 161.8 of this last move, this little move to the upside. So anywhere between 70 cents and 70.2 cents, it's a good area of support. So we already tested that. Let's see if the pair can rebound from here, because if it can't, that's also a very, very bearish signal. I wouldn't find it impossible, though, to see some rebounds from here, even if they end up being corrective. Both of the pairs have been very, very oversold, and a relief rally of some kind is very likely. Let me also have a look at the Euro Pound. I'm not going to show USD Swiss. Blake already showed that. Euro Pound is pushing once again to the upside. I know that people keep asking about it. I said it yesterday and I was very clear about it. In my opinion, since we've been stuck for 6 months now, more than 6 months, 7 months now, in this slightly descending channel, anything between support and resistance is just noise. So personally, I'm not looking to do anything about it. In theory, a daily close above the 88 cents level is somewhat of a bullish development, but we will still be in the middle of the channel, right? So I would honestly just say once again that we need to remain patient. I'm still short, by the way, euro yen. Not very happy about it because it hasn't moved a lot. I'm just like 45 pips in the money. I might even book profit if I don't see it lose the 131.50, 131.60 area soon, because for me to confirm that this ascending wedge and the fact that it's breaking below is actually means something from a technical perspective. I would want to see some kind of an acceleration. We don't have that yet. I will definitely not let that position turn against me. As I did with the SPX, I got stopped out yesterday once again at break even, but it's okay. I mean, I've had 2 out of 2 attempts getting stopped at break even. I'm very, very strict with my stops here. I move them very fast to break even because, as I said yesterday as well, being trapped within a triangle and being almost in the middle of the triangle obviously does not allow for much of a conviction, right? So, I'm very, I keep trying to position myself here, but I'm very careful. I don't want to lose money due to that because I don't have the required conviction. Now, USD ruble, on the other hand, I'm still long. I'm now more than 3.2% in the money. This has been a nice trade. I think it has more upside. I might consider booking some pre-Fed tomorrow, but we'll see about that. Now, a fast overview at a few more pairs. USD SEC penetrated the confluence of resistances, and actually accelerating higher. The move now has almost become parabolic. Since we managed to break above here, I would be looking for this area to act as support whenever we get some type of a pullback. Regardless, we have to say this has been a very strong move. USD NOK, I said yesterday that we either get rejected from there. If we don't, the next stop is at 812. The 61.8 and this parallel trend line support. If we draw it from there, it's there at 812 roughly. I have to be honest. If there is one pair that I'm looking very seriously in being short the dollar at the moment is USD NOK. So if I see a rejection from there, I'm definitely going to be a seller, right? I do like on the long term. NOK as a currency, I am very bullish. He's not here yet. Let me ping him. I'm going to start looking into questions and I'm going to ping Andrea. Let me see. No, it's my mistake actually. He's here. Andrea, I'm promoting you. There you go.
Hello,
hey,
everyone. Can you?
And I'm giving you, and I'm giving you the screen, mate.
Okay. Thank you.
So we need you to shed some light for us. What do you think? Because we're ahead of the Fed. We've already seen the dollar push higher. It hasn't yet broken above all the resistance areas we had indicated. I forgot to show the DXY. We still have some major resistance at the 92.50, 92.60, 92.58, if I remember right, is the exact level area. What do you see from a technical perspective? I mean, I'm not asking you to predict what the Fed is going to say, but from a technical perspective, do you think that we're close to getting some type of a pullback?
Well, we are retesting the zone we were expecting. So it's always interesting when the market or when we are facing the right direction inside the market. So actually, there's nothing to add to your previous comments, Steve. So we are now facing, and we are now very close to the next zone from the previous head and shoulder, which I believe is the strongest level at this moment to retest, very close to the 61.8. We are now also above the default target for this bullish crab at 50% retracement from all this bearish momentum, as I was expecting for that pattern. But it's a strong fib level. There's a few confluence zones there. I was expecting, and I'm inside the market with Aussie, expecting a small pullback on dollar at those levels. The market has failed to, at least for now, is failing to reject those levels. The 161.8 reversal, natural fib extension, reversal zone. Actually, the market has nailed the 161.8, has printed a small pullback, and now are trading above. So, but it's a strong level. It's a zone where I will not be surprised at all to see a pullback or a small relief on dollar, as you mentioned before. But again, 61.8, the golden ratio, it's also a very interesting level to search for. A nice confluence here between previous structure and that fib level, the previous support and resistance. So I will not be surprised to see the dollar retesting that zone and then a small relief. Again, the 161.8 is a natural fib extension zone for a reversal. It doesn't mean the market will reverse stronger from there, but I have two levels at this moment in order actually to identify harmonics and to identify advanced pattern. I have two levels of interest. One of them, the zone we are trading now, and the next one should be the 224 extension. Actually, there's a small box between the 78 and the 224 extension, and obviously the bat pattern, this bearish major bat pattern, eventually at 88% retracement, it will put the price at 94.36, 224, and the golden ratio here. So we are now trading above the default target for this bullish harmonic, and this is my approach for dollar at this moment. So at this moment, I'm inside, as I mentioned before. I'm dealing with the frustration on Aussie at this moment. It makes part of the process, but I need to assume that. So I'm dealing with the frustration of buying the Aussie at the structure at the bottom of this major bullish structure.
Andre,
yeah.
Since you mentioned that, where is your line in the sand for the Aussie? I mean, where is the level that you consider that you will consider that the market is doing something totally different here?
No, I have my validation points, a few points below the pattern, the initial points. Below those levels, I never know where the market will reverse or not. So I know where the pattern will invalidate, so I need to respect those levels. Below those levels, I don't know what the market will do. But considering the price action and what the market tends to do on those type of structures, I will not be surprised to see the Aussie searching for a deeper pullback from all this momentum here, and eventually we are dealing and imagine the golden ratio of 0.73 retesting previous structure supports. I will not be surprised. So, but again, we are trading below the 38. We are approaching the 50% retracement. Also, we can search and identify structure support and resistance levels at those fib levels too. But it's always very difficult to understand where the market will find a support. So we know at this moment we have the market at oversold conditions on a daily and we have here what I expected to be eventual reversal, heads and shoulder on MACD. Usually when I see the market respecting that shape on MACD, I will see also the market printing some reaction there. So note that the 88% retracement from all these movements, so the pattern completion point, is also at confluence with that 38% retracement there, or actually the 78% retracement, and a few points below the completion point for this harmonic. So I trade based on those structures, and I know where the market will invalidate them. So I just need to but again, Steve, I don't know if the market, what the market is showing at this moment is not respecting the shaping and on MACD, showing eventually some more bearish momentum. We have our RSI also extremely oversold. And if I look left into previous price action below the 200 media average, we can see some reactions inside or below that media, and eventually we will face something similar. So a retest to the 200 media, new low, and then a rally. And again, the same thing here, below the media, retest the media, new low, and that's what I am expecting. But again, we are trading below this major bullish structure, and obviously, if you go into a weekly chart, well, we can deal with different approaches here. So we have one.
I think that on the weekly chart, this move higher looks very much as a long-term correction to be a very strong downtrend, right? I mean, in my opinion, if we close the week, especially below the 75 area, which will also register, we've already registered close below this trend line. But if we also close below 75, the 75 cents area, we also have a lower low on a long-term chart after a very long time, right?
Yeah.
So I think that's going to be very bearish.
Yeah, the probability to a very deeper pullback will increase for sure. Actually, we are facing a strong bearish market, so actually, I believe it's no difficult for us to understand it. So actually, we tend to use the 200 media average for some reason, and that's the reason. That's a market trend marker, and we are facing a strong bearish market even on a weekly or a monthly chart also. So and it's a counter trend setup, obviously, but for those who are trend followers, obviously they search for opportunities to short those markets, not the reversal.
Andre, what do you expect? I mean, a lot of people are perplexed with what the metals are doing. You know, we were attempting to break higher, like what was it, like 10 days ago? We failed once again. We're back range bound. Do you have some harmonics outlook about what the next move in metals should be, or you're also keeping a neutral outlook for the market at the moment?
No, I
like gold, silver.
Yeah, I've been kicked out from gold this morning in a lower time frame chart. I'm being kicked out from one position, but we are facing. This is a weekly chart that I'm showing you here. We are facing bearish divergence, which eventually will force the price to break even or MACD, and eventually will force the RSI to search for oversold conditions at the 200 media average eventually. So let me jump into a daily chart and let me push my flip.
So you're bearish gold, right?
I'm neutral at these moments, but I do believe the market will search for lower levels and then later to rally.
Okay.
I don't believe the market will violate those bottoms. But it can happen. Obviously, we will be trading below the 200-media average, which can force the price to search for a lower price. But at this moment, and based on this structure, we can only search for an eventual, let's say, the BAT pattern at 88% retracement. Eventually, we will search for the 1250. Based on the most recent price action, this is the pattern the market can print us, but we need to wait for that pattern to happen. And we are now facing on a daily, obviously, we are now facing the 200-media average at 50% retracement, a few points above, and we have actually not yet. We are trading above the previous structure support. Actually, we are now retesting that zone. So we need to violate those zones first in order to then later to project this or to validate at least the probability for that pattern to work well. I want to show you also, but actually on metals I'm neutral for all of them. I've been kicked out from this buy opportunity here in the 2 hours or 4 hours chart, and so I just need to wait now. When I face markets that fails to achieve my targets, sometimes I like to stay away for a while and to watch what the market is, because somehow if I fail one trade, it's because I'm at the wrong position. So I'm at the wrong side of the market. So I need to reposition myself, and I need time to do that. Actually, I want to share with you also that CAD that you have mentioned before.
Yes, if you can.
And because this is a chart that I published inside ForexAnalytix.com. So for those who are here for the first time, I take the advantage to invite you to join us inside this amazing platform. So this is the chart from 26 March, and this was the, let me push it again. So this was the eventual, at this moment, the eventual edge and shoulder.
Left.
Sorry, Dale.
Oh, my guest. I think he left. Yeah.
Oh, do you need to recover him? Or?
No, Dale, he didn't leave. I just promoted him because he was asking on the question box.
I see. Okay. So you made him a panelist? Okay. Thank you, Steve.
You just need to unmute him whenever you're right.
All right.
I can finish, Dale. I can finish just with this CAD approach in order to get you inside.
Yeah. Oh, that's a nice look, Andre. It's so great having you as part of the team, man.
Thank you very much. I try my best, and I believe it's a pleasure for me to be here. It's an honor to be part of this team. It's amazing. It's an amazing project, amazing platform, technology, and people inside. It's actually amazing. That said, and to finish my approach today, and I will have more time, obviously, to be here with you. But this was a chart from March 26. We were expecting the edge and shoulder formation here. The market has respected, the market has failed at 61.8 above, but it has respected the shape, and it has completed the shark pattern at 161.8 extension, synced with the 78, and we are now trading at 50% retracement. So the pattern worked very well, and we are trading above, below a few points below the 61.8. At this moment, we have no pattern, no advanced, no harmonic pattern in place, actually being printed here. We have only the very, let's say, remote cup and handle formation eventually. At this moment, not very clear. I'm trying to print that pattern here. Something like a pullback into the 38% retracement is a minimum requirement at this point. So I will not be surprised to see CAD pushing back into those levels and eventually to print a new high above the most recent ones. But again, I search for those advanced patterns, and I try to apply a risk strategy behind to support them. And at this moment, I'm sitting at the wrong side with Aussie and kick it out from gold. So I need to reformulate my ideas again and to recover those and to keep the process rolling. So Dale, all yours.
Thank you, Andre.
Thank you very much.
Thank you, Steve. And Jonathan, I'm unmuting you, and then I'm going to be showing your website.
Good. Can you hear me?
I can, Jonathan. Great to talk to you again, buddy.
Been a while.
Yeah, I don't know how many years. Do you? I think we've gotten a little older.
Yeah, it's probably 3 or 4. Yeah, I just turned 65 actually, Dale. So you know.
Oh.
You can disregard everything I say.
We're the same age, huh? So yeah, what a great. Okay, everyone, this is what happens when two dinosaurs get together and talk about markets and retirement. So we still have one leg outside of the tar pit, Jonathan. And you know, I love your new mission. I'm so glad I reached out to you. But why don't we start with your headline? I'm showing your website right here. Is it wise to sell in May and go away? Hasn't worked in 5 years. What are you thinking in here?
Well, this is a guest blog by Adrian Mastraki, who is a financial advisor in Vancouver. He himself, just to the theme, has already passed the age of 70, and he hasn't plans of slowing down anytime soon. I guess he's like most people. It's like market timing. I know there are some people who believe in the seasonal trading, and then once in a blue moon it actually may work. But I think for the most part, when you consider the tax events and the trading costs of trying to be right, both getting in and out, you're just best to keep to the pattern. You know, keep to the program and maintain your strategic asset allocation, and keep in mind your long-term goals. Now, you know, as far as I'm concerned, as a semi-retirement, I talk about the glide path to retirement, where, you know, retirement is no longer a instant. Like, you don't, if you see an airplane and it's going to land in Seattle, for example, it doesn't start the descent when it's above Seattle. It starts like hundreds of miles away, right? Very gradual.
Right point.
That's the way I look at retirement as well. So
okay, all right. So, you know, let's get into your passion, and let me be frank. You know, having been a trader, and I always, you know, I'm pretty public about my life, Jonathan, because I want people to learn from my mistakes. And you know, this is a very interesting topic, because guys like me are really only supposed to, traders, have about 10% of our assets in a speculative arena, correct?
Yeah, you know, I look at the, I mean, for example, I listen to Jim Cramer on his podcast. It integrates as part of my walks. I mean, people think he's a crazy, mad individual stock guy, but actually, if you listen to him, mad money is just like you say, the 10% of the money you can afford to lose on individual stocks. He's actually an S&P 500 indexer for the first $10,000, which will surprise people who don't really listen to that particular show. So,
okay, that's important, because, you know, Jim used to run a hedge fund, so he also had a lot of tactical things that he did, you know. And as traders, we think that, you know, we know markets, so why do we need a long-term plan if we're always going to be right short-term? The problem is we're not always going to be right short-term. Sometimes our shorter-term biases take us off track from a longer-term weekly, monthly trend, macro trend. So why don't we get into how people can discipline themselves, and when you have windfalls and speculations, where do you tell people to put that money?
Well, you know, I'm more of the strategic. In fact, Vanguard, at least in Canada, now you notice from my website that there's a lot of ads there, so take it with a grain of salt. But I was always a big Vanguard fan long before I worked with them, because I thought they were the best deal for the investor. They were tax efficient, low cost, can't beat it. And they, at least in Canada, and I think in the States, came out just recently with these 3 asset allocation ETFs. And they're really the only, I mean, with 22 basis points, 0.22% expense ratio, which is half of any robo-advisor even. And I sometimes worry, and maybe you do too, if you have a partner, if you're no longer around there to make decisions for them, what are you going to do? You're going to find a high-priced advisor, or you can just keep what you've got and just say, look, I trust Vanguard's asset allocation. They'll let you choose between 80% equities or 60% fixed income if you're conservative, grow, and balanced are the three. And I think the vast majority of people could benefit from that kind of approach. It doesn't have to be complicated. This stuff shouldn't have to be rocket science.
You know what? I think what a lot of people have in their head, Jonathan, is what happened to them in 2000 and 2008. And even though they had diversified portfolios, had a portion in cash, portion in bonds, maybe different sectors in the market, it really didn't save them from the pain. And a lot of them won't even open up their statements for a period of years. So, what do you say to people that still have that pain registered in their market memory about staying the course, like a guy like John Bogle would say?
Well, I'd say that you have to diversify among product, not just asset classes and geographies, but also even investment products. And I think in the case of annuities, the people who would have had partly annuitized, like you could say, well, what annuities do I already have? If I have an employer-defined benefit pension plan, maybe that's an annuity, though those are become rather rare. Social Security is going to be basically an annuity, inflation index. But if you have nothing but a 401k or defined contribution pension plan and it's completely in the market, up and down with the market, then I think you need to pensionize that nest egg partially. I'm here in Canada. We have an author who wrote a book on sourcing retirement income, and he himself was really quite nervous. Same age as you and I, Dale, 65. Okay. Quite nervous about the fact his market exposure. So his recommendation, I wrote about it in Money Sense magazine, was to partly annuitize, even at 65, which is earlier than most. Most people say late 60s, 70s, even 80s to annuitize. He said, no, annuitize, if you don't have any other annuities, no pension, no corporate pension, defined benefit, then annuitize 30% of your financial assets at age 65. And then at 70 would be Social Security, because most people will say, if you cannot do it, avoid taking a Canada Pension Plan or Social Security until 70, because it's going to be, 40% higher than if you did it at 65 or 62. And then that's sort of like the second tranche of annuitization. So at 65, you do it with real annuities from an insurance company for 30% of your portfolio. Social Security kicks in at 70, and then at 75, you kick in the second 30% of your remaining financial assets. That is one way to handle stock market fear.
Okay, so I want to talk about annuities for a minute, because they get kind of a bad rap with some commercials on CNBC, and in my own experience, found that a lot of salespeople gravitated towards annuities because of such a high payout that they got. The commissions at times were close to 10% of what was annuitized. Is that correct, or is that a misguided? Well, and you really have to, buyer beware even in annuities, right, Jonathan?
Yeah, or especially annuities. I mean, personally, I haven't yet purchased any, apart from the annuities I have in my employer pensions and, old age security now here in Canada. But I think it depends. I think variable annuities and the annuities sort of tied to the market, they can be a little bit costly. That is true. But I think you can certainly investigate the market and try to find a bargain if you can through a proper financial advisor who's got your best interests at heart. And if you do that, I don't think you need to shy away from them totally. All I'm saying is they should incorporate them as a portion of your approach to drawing down investment income or retirement income.
Have you seen the commercial on CNBC where a guy named Ken Fisher says, annuities, I'd go to hell before I would sell an annuity? Have you seen that one?
I haven't seen that one, but
maybe they only show it in the U.S., Jonathan. But obviously he's selling, his services. I think he's an RIA, and you know, charges a percent of assets under management, but, you know, he's basically saying, you know, it's mainly in the salesperson's interest, and they could duplicate what you do in an annuity with their products. So anyway, I just wanted to touch upon it. Your annuities don't get that kind of bad press up in Canada, obviously.
Perhaps not as we're aware of the bad press, and I think maybe the press is a little bit more is worse reserved.
Just lost you, Jonathan.
Oh, can you not hear me? Or
Okay,
you've lost
better
me conceptually.
now. Better now.
Okay. Yeah, no, I was just saying that I think most financial advisors are probably compensated based on their percentage of assets under management. For them, ironically, that's their annuity to have a couple hundred clients all paying them 1% of their portfolios. So naturally, they don't want to lose that money to an insurance company. Right. I'm not, you know, particularly flogging annuities. I haven't actually bought them myself. I think at some point I may, and that's about the extent of it. And I only responded because you asked me what I thought.
Okay.
About.
So let's talk about what everyone has: debt and frugality.
Well,
one of your headings here. Go ahead.
Well, you know, to me, as I say, the foundation of financial independence is a paid-for home. So I don't even believe in going into retirement with any debt, not mortgage debt, no credit card debt at all. You know, I'd rather own the credit card companies, Visa and MasterCard, and be the collector of dividends based on people in debt than be the person financed. I'd rather be the recipient of fixed income, not the disher outer of it. So, you know, maybe.
So debt is bondage. Debt is bondage.
In my opinion, now I realize in the States that you can deduct your home mortgage debt from your taxes, and there's a real reason to continue to have a bit of mortgage debt. That's not the case in Canada. So Canadians are sort of trained to get rid of the mortgage as fast as possible. Plus, we're not as big risk takers, so we tend to shy away from even credit card debt, and particularly if it's at 20%. I mean, there's no return that I know of that's guaranteed at 20% in the stock market that equals the return from just getting rid of high interest debt.
Our president brags that he's the king of debt. What's it look like from Canada? What's happening here in the States, Jonathan? Go ahead. Well, you can be straight with me.
We pay a lot of attention to the Trump administration. I mean, I watch CNN as much as I watch Canadian shows. I read the New York Times and Wall Street Journal as much, and you know, it's basically all Trump all the time. It gets a little tiring, of course. I don't know. He's got some very raw instincts, and sometimes he seems to be able to turn it into gold. But it remains to be seen. I mean, they're already tromping away at trying to get a second term. I think they're starting to talk about it. I don't know. I mean, so far the market has responded relatively positively. It seems to be a little bit on hold right now with this whole tariff stuff. I mean, I know there's a 1 month reprieve right now with Europe and Canada and the things. But I would say that the fear of a severe market correction that we saw in February, March has not yet dissipated, and Trump isn't helping any. The tax cuts sort of help, but if you read Paul Krugman in today's New York Times, he's pretty skeptical that the tax cuts have really significantly contributed to economic growth thus far.
Yeah, they definitely contributed to a parabolic move in the market into January. Yeah, you know, I've been reading articles for years about here in the States, the safety of pensions. You know, a lot of these pensions have been squeezed over the years because of low interest rates and being forced to out on the risk curve, and they needed like 7, 8, 10% just to break even with their pension. Do you have any view or any advice for someone who might be worried about his pension down the road being what it is today? Is there anything someone could do about that?
It depends where you are. If you started to collect the pension already from an employer, it may not be possible to do much. If you're approaching retirement and you still have the option of commuting the value and folding taking the value of the pension, putting it into your 401k or into your IRA, That is an option. I don't recommend it. I think that for the most part, pensions are run relatively prudently and at a relatively low cost, often lower than 401ks. But it all depends on if your employer, you know, like you mentioned Trump. I mean, if you're part of a debt-ridden organization and you think that there's a chance that the pension fund may not be there for you, then yes, I would take the cumulative value, at least partly.
Well, I mean, it's not just companies. How about states, like the state of Illinois? A lot of these, you know, a lot of these pensions are making people take cuts in what they originally promised people.
Well, you know, they call it the pension promise for a reason, but if they're breaking the promise, there's not much. If you're a state employee and you've been in your career 30 years in a particular state's pension plan, you're basically, you can't really negotiate it. You're helpless. You're depending on a promise that somebody may not make. Now, there is, of course, and you could tell me if I'm wrong, the Pension Guarantee Fund. We have one not across Canada, but only.
It's so low. It's so underfunded. It's almost comical. If there was a problem.
Yeah, you know, if you want to be really negative, you could get really paranoid and say even Social Security is not going to be there, my pension's not going to be there, the market's going to crash. I mean, we could all put our heads in the sand and like, oh, woe is me. I think you got to have a little bit of positive, hoping things will work out for the best. Otherwise, you know, there's a rock wherever you look. There's going to be these horrible things happening. I don't think the average municipal employee or government employee in a pension plan should. I mean, in Canada, we mostly envy anybody in that kind of pension plan because it's basically taxed by the taxpayers. But again, I mean, the more you can get your assets under your own control, and then if you properly asset allocate, like the Vanguard asset allocation funds I mentioned, so that you have 50 or 60% fixed income or as much as 60% equity. I mean, diversification is the only free lunch. Diversification globally across asset classes and geographies, plus products, as I said, so you have some money in the financial markets, some money in annuities. Hope that the Social Security promise will be there. It should. I mean, at least Trump has not threatened. That's the one thing he's been pretty consistent on. He's not going to go after Social Security. So at least we can probably sleep better at night with that realization.
What do you favor in a rising interest rate environment that we're finally in?
Well, again, a balanced portfolio. You don't want to have
bond-wise.
Sorry?
Bond-wise.
Yeah. Well, I personally, I put a lot of my fixed income in 2-year GICs. You would call them CDs, certificates of deposit.
Okay.
Going over every 2 years because they pay better than a 1%, than a 1 year, and certainly better than the T-bills. But at least, and they're going so cautiously and slowly. We know they're going to have 2 or 3 more rate rises this year. It's always by 25 basis points. So even a 2-year commitment would mean only maybe a 1.5% higher a year and 2 years from now. And at that point, if rates are higher, then you go ladder it out to another set of 2-year CDs. They're also fixed.
It's actually good for savers, don't you think? I mean, for all this, better, not great for savers, but better than it was, where banks were paying 0.25 or.
Oh, it was terrible. It was called financial repression. The savers and retirees were prudent and didn't go to the market were punished with, as you say, almost zero interest rates. At least now you can get maybe 2 or 2.5%, and if the rates sort of inch up more, then maybe you get 3 or more. There are also fixed income ETFs, exchange traded funds. There, I would keep them into shorter term ones, the ones that don't have too long a duration. Same idea. You don't want to commit to 10 or 20-year time horizons because, as you know, if rates continue to go up, the value of those bond ETFs can go down. I think a lot of retirees are shocked to see even medium level fixed income ETFs have sort of been down in value. They appear to be down in their capital value, even though they sometimes don't factor in the interest payments that are being made. and then, of course, equities. I mean, obviously, most retirees are going to need stocks or equity ETFs with companies that are growing their dividends, because inflation is always the big bugaboo. I think right now the Fed is sort of acting as if it's about 2% inflation, which gives you another idea. TIPS, Treasury Inflation Protected Securities. We haven't had a lot of talk about them in recent years because inflation's been so dormant. But I would say, again, if you're going to have some CDs, some short-term fixed income ETFs, and the third element would be the inflation hedge, which are TIPS or Treasury Inflation.
Okay, your native currency has been pretty volatile over the last couple of years. Do you pay attention to what the loonie is doing, Jonathan?
Well, of course, once upon a time, Canadians were forced to invest 70% of their equivalent of the IRA in Canadian securities. You know, what we have in Canada is we have something called Canadian banks. And so, I mean, I invest a lot in your FANG stocks, for example, in the U.S., a lot of U.S. stocks, but I don't feel a need to go and buy, Bank of America or Chase Manhattan or anything like that, because the big five Canadian banks are like money machines. I mean, they consistently pay 4% dividends. In fact, sometimes there was articles in the Canadian press that why would you have anything else but a Canadian bank stock? My father-in-law was a dairy farmer, and he figured all he needed was the milk quota and Canadian bank stocks for his retirement. Then, of course, and then Canada has a lot of resources and energy things.
Right.
That's been a little dicey because we have companies with like Enbridge and TransCanada pipelines, and we've had all these problems with the Trudeau administration kind of blocking various pipeline projects. So, and then of course you guys haven't made it easy for us because the taxes are coming down, and the corporate tax in the States is making Canada less competitive from a tax perspective. Money is starting to flow out of the country, and so people are a little nervous up here.
Okay, let me ask you, in Canada, is there a cryptocurrency craze going on up there?
Oh, yeah.
Any comment on it?
It's everywhere. You know, I've not invested in any of that stuff. I mean, personally, I still prefer gold as my hedge currency. When we were talking about tips and inflation, I've always thought maybe a 10% position in gold, or at least precious metals or precious metals or bullion ETFs was prudent. Whether crypto is going to replace gold, I don't know. I just rather wait and see. The real big craze, of course, in Canada, apart from crypto, is marijuana stocks, which are starting to creep over the border there as well. But Canada legalizes in July, and I know in California and about 8 or 9 states, it's the same thing is happening. Personally, I prefer to play the marijuana thing through ETFs with a tiny portion of my net worth. Hasn't worked out great so far. And there are sort of a lot of these quasi kind of, you can invest in, Altria and some of the tobacco companies or Constellation Brands that recently bought a minority position into Canopy Growth. I think another one is, Scott's Miracle Grow is another one. So there's a various sort of marijuana plays that aren't necessarily committed to marijuana itself. But personally, I find that a little more promising than cryptocurrency. I just don't understand cryptocurrency. I don't think 65-year-old guys should be messing much with cryptocurrencies. Do you, Dale?
I have a hard time wrapping my head around it too, and price discovery. But I am attempting to edify myself in them, because everyone's saying blockchain is here for good. Whether Bitcoin's the king or something replaces it, that's another story. But what a great interview, Jonathan, and really I've enjoyed getting back together with you. During our interview, and you brought up marijuana stocks, I'm staring at this pretzel rammy pastrami sandwich on your website, the top ad from Togo's, and looking forward to lunch now. Just talking about marijuana stocks gives me the
one of our advisors, Pat McHugh, recommended PepsiCo as a related marijuana play, because people who get high get the munchies, and so they're going to go for the snacks the Pepsi sells. So you can think creatively about how to play that play. I can't think how to do it.
And someone in our community said Canada manufacturing PM due in 7 minutes. Do you think Canada is going to remain strong? I mean, with higher energy prices, it should help, even with the real estate market bubble beginning to give way in Toronto.
Toronto and Vancouver is still pretty pricey. And personally, we have a house here in Toronto. It's paid for, but we bought it like 25 years ago. So we're sitting there.
Right.
We got a capital free gains on there. So a lot of Canadian retirements are riding on a paid for home. I don't worry too much about it. As I said, the Canadian banks are very strong. Remember in the 2008 recession, or whatever you want to call it, financial crisis, it was the U.S. bank stocks that were and financial firms that were leaders. Canadian banks came through smelling like roses. So I can't imagine. I mean, it's like a monopoly because they're all, unlike having a lot of small local regional banks in the States, all the Canadian banks, all the big 5, 6, are all national across. Now, it's true it's a country 1/10 the size, but they are as stable as heck. You can't go anywhere without seeing 2 or 3 Canadian bank branches in any street corner. So 4% dividend, I'll take them. They keep on growing them, I'll take that as well. I don't worry too much about the Canadian market. I certainly like, I love owning Amazon and Google and Facebook and all that stuff. But we're allowed to own all those stocks as well. So we do.
Well, I'll tell you what, Jonathan, if people just listen to your tone of voice and demeanor on this interview, they could tell how relaxed you are and what kind of conviction you have, that you put your mouth where your wallet is. And I think it's really a great mission that you have for people, because a lot of people have fallen through the cracks and are going to have uncomfortable retirement. So what a great mission, so that people could enjoy their golden years instead of struggling during that time in their life.
We call that victory lap retirement. That's the victory lap. So as you sort of go down in the glide path, it can help you.
Okay, well, it's obvious to me, Jonathan, you're enjoying this time in your life, that you're, enjoying your victory lap. I hope you have years of victory laps ahead of you, and that you touch a lot of people and help them enjoy their years later on, instead of having to depend on something like Social Security. So congratulations in your mission, Jonathan.
Here on in.
Okay, lost you for a second.
Yeah, no, I just said I hope we can do this in the future every once a year or two, and update the progress of our victory lap here.
That's a promise, Jonathan. Thank you so much, everyone. That's Jonathan Chevreau. Here's his website, www.Financial Independence Hub, and you could follow him on Twitter at John Chevreau. So that's it for Turnaround Tuesday, everybody. Enjoy the rest of your day. See everyone tomorrow. And remember, don't just count your pips, count your blessings, and think long term, not just short term, about where you want to be with your family and your spouse when you're the age of Jonathan and me. Adios. Thank you, Jonathan.
Thank you, Dale. Anytime.
Okay, buddy.
Okay. Bye-bye.